Joining us right now is Kari Firestone, Aureus Asset Management CEO and CNBC contributor. And Kari, let's talk a little bit about this week, because this has the feeling of a real inflection point. I don't know if it sticks, but you're looking at the markets up significantly. You're talking about rotation out of some of the names that have done so well into some of the names that have not. If you're looking at small caps, mid caps, financials, real movement taking place. Do you think this lasts?
Well, it's definitely off to a good start pre-Thanksgiving. What we saw last week, as you said, was just a huge rally across the board. The S&P 500 was up slightly more than 2%, but the S&P equal weighted, meaning if you just don't weight, you're just talking about all the names in the S&P, that was up 3% since Monday. And almost all stocks participated in that rally on Monday. I think the number for the total market is close to 80% for the week. And that is very different from what we've seen previously this year, where 7 stocks more or less dominated the market. They returned about 85% through September 30th of all the return of the S&P. And if we broaden that out, which we need to do to have a sustained rally, that would be great for the market. And it's signaled by lower interest rates. Potentially inflation is coming down, and we'll get some earnings growth next year, which has been questionable for many people.
We've been getting the retail results in, and there are some concerns about the consumer at this point. Is that enough to lead you to broader concerns about where things stand, or do you think that we are headed towards the soft landing that has been this hard-to-reach goal?
Well, it's interesting. Retail stands out as being soft right now, both at the highest end. Yesterday, I think Burberry reported weak numbers. Right. We've seen weakness from Richemont and LVMH, and then Target had, and Home Depot also had weak sales numbers. Although these can change pretty fast. You can have these numbers start to look good in the first part of 2024. We have to keep an eye on it because we live in a consumer economy that's close to 70% of GDP. But that can change, and we know unemployment is still strong. Unemployment is still under 4%. Jobs growth hasn't been as strong, but people are working, and we think that it is likely the consumer will hold in, maybe not be as strong as it has been, post-COVID, but hold in enough so that we can have that soft landing.
Let's talk about a couple of names you have been adding to. One's Charles Schwab, the other is Charter Communications. You like both of them, unrelated stocks, but both of them have been under some pretty severe pressure, and you think this is the time to jump in?
Yeah, we do. Charter is a company that has spent a lot of capital on developing rural build-outs, and that's a multi-year process. And we think that beginning at the end of 2024, you're going to really see the benefits of all that build out. We've already known that people have been cutting the cord, but you need Wi-Fi. And that's what Charter and the cable companies provide. And so this is a stock been under pressure. Higher interest rates have hurt it. It's a very low multiple stock, and we like it at this price. On Schwab, it's a different story. Because of interest rates going higher, many customers have swapped out of their lower interest rate money market funds into higher funds for obvious reasons. That process is ending because interest rates are unlikely to go higher. It's a company that has continued organic growth with new customers, and Ameritrade was a purchase they made, and they'll begin to get the synergies from that acquisition this year. Again, a very low multiple stock, and we think at this price, extremely attractive.
What else do you like?
Well, we also like names such as Google. It's interesting. Both Google and Meta are not in China. People talk about the weakness in China. They've never had that problem. They never had the strength in China or the weakness. So we think Google's an attractive name here. And you've got AI. It's a market multiple stock. Still incredible growth on their various platforms. Wabtec, which is Westinghouse Airplanes, they make cars for metro transit and for railroads, and that business is strengthening. The railroads need new cars, and certainly urban transit does, and the infrastructure bill is helping them. And American Tower, which was hurt by higher interest rates, and people need their cell phones more and more, and we think that's an attractive way to play it.
A lot of this is based on lower interest rates. If interest rates were to turn around and rise again, would you change your thesis on any of these stocks? or the markets overall?
Probably.
Yeah.
Yeah, I think probably. I mean, the assumption is that rates are sort of up where they're going to be, sort of settling into coming down. They're definitely having an effect across the economy. Just look at the housing market. Housing and cars have been, weak because of mortgages, and around the 8% level or higher for car loans. It really affects demand. You're seeing it in many parts of, capital spending for industrial production. Higher rates hurt. So we are of the belief that because inflation has come down, the Fed doesn't have to keep pushing rates higher. And that's what the Fed wanted to happen. That's what the economy needs for that soft landing. And we should begin to see that benefit over the coming months.